This is how Warren Buffett chooses his stocks. Warren Buffett is arguably the greatest living investor. He went from buying his first stock at the age of 11 to owning multiple companies at the top of the Fortune 500 list. Buffett's personal wealth ballooned to over $80 billion as of October 2019, making him the third wealthiest person on earth at the time. Given his decades-long track record in the market, many investors want to learn how to pick stocks like Buffett. But for individual investors, including his own wife, Buffett offers a different investment strategy, and it's one that has nothing to do with picking individual stocks. In the 2016 annual meeting of Berkshire Hathaway shareholders, often called the Woodstock of capitalism, Buffett reportedly responded to a question about how an average investor should manage their funds by saying, just buy an S&P index fund and sit for the next 50 years. Buffett's dislike for expensive investment managers is clear, and he doesn't suggest his trust hold a single stock, not even his own company, Berkshire Hathaway. Instead, he suggests funneling stock investments into an S&P 500 index fund, a type of mutual fund that follows the performance of 500 of the largest public companies in America. Buffett's belief in the S&P 500 is so strong that he bet $1 million that the S&P 500 would outperform a selection of top hedge funds over time. Value investing. Berkshire Hathaway was built on investing in individual companies, and its portfolio contains billions of dollars of stock investments in companies including Wells Fargo, American Express, and Coca-Cola. It's a portfolio built on a philosophy called value investing, which was pioneered by Benjamin Graham, Buffett's mentor and a professor at Columbia Business School. Value investing ignores swings in the markets and focuses on a company's intrinsic value. Buffett and his team look for companies that have a competitive advantage, great management, and a higher true value than the current stock price. If you wanted to pick stocks, value investing would be a fine strategy to follow. Still, keep in mind that Buffett and his investment team manage billions of dollars in assets and have the ability to make massive investments and influence the operations of the companies in the Berkshire Hathaway portfolio. Individual investors are typically working with thousands of dollars and do not have time, assets, or expertise to make Buffett's success. Keep in mind also that individual investors, unlike a huge institutional investor like Berkshire Hathaway, are less able to handle the big losses that come with investing in the market. And make no mistake, those inevitable losses will come. If you want to follow Buffett's advice for individual investors, here's one way you might go about it. These examples include Vanguard mutual funds and exchange-traded funds, but whatever fund family or brokerage you use will have similar options. As with the S&P 500, you can buy a mutual fund or ETF to invest in a basket of short-term government bonds. Vanguard offers its own short-term government bond ETF with ticker symbol VGSH. It also offers an Admiral Shares short-term bond mutual fund under the ticker symbol VSBSX, which also has a $3,000 minimum investment requirement. Index funds. Investing in index funds has several advantages over picking stocks. Instant diversification. When buying individual stocks, you need quite a bit of time and money to build up a diverse folio. Diversifying across companies and industries is also important. An investment in an S&P 500 index fund gives you 500 companies at once. Like a bet on the U.S. economy. Betting on the 500 biggest public companies in the United States is comparable to a bet on the overall U.S. economy. While a company may follow the fate of Enron now and again, these companies are generally stable, blue-chip firms that will experience long-term stability. Easier to control emotions. The best investment plan is to contribute little by little over time. When you buy and sell individual stocks, you're always in the mindset of buying and selling. This inevitably leads to many investors to buy and sell at the wrong time. Timing the markets is virtually impossible. Instead, follow a tried and true course of periodically buying index fund shares. Lower trade fees. Buying and selling stocks to build a portfolio can be costly in terms of trading fees and commissions. However, most fund firms offer access to their own S&P 500 index fund for no fee. It seems like every week there's a new flashy Silicon Valley startup announcing its IPO, and it's tempting to want to get in on the action. But is buying a stock in a new public company the best idea? When it comes to investing, Berkshire Hathaway CEO Warren Buffett doesn't have a complicated method for choosing what to buy. Instead, he keeps things simple by following a few steadfast guidelines. According to Buffett, the fundamentals won't change. You're not going to discover anything new about investments in the next 50 or 100 years. Buffett believes in choosing the best company rather than the best stocks. He has two simple pieces of advice for the budding investors. Number one, always look for the company that has long-term value. Buffett looks for businesses that will continue to have a competitive advantage decades down the line, not just in the moment. Nobody buys a farm based on whether they think it's going to rain next year, he said on Squawk Box in 2018. They buy it because they think it's a good investment over 10 or 20 years. For example, he purchased See's Candies with longtime business partner Charlie Munger in 1972 and spent more than $1 billion on Coca-Cola stock in 1988, both of which turned out to be good bets he still owns today. Put together a portfolio of companies whose aggregate earnings march upwards over the years, and so also will the portfolio's market value, Buffett wrote in his 1996 letter to shareholders. If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Number 2, understand how the business works. Buffett doesn't put money into anything he doesn't understand. You have to learn how to value businesses and to know the ones that are within your circle of competence and the ones that are outside, Buffett told Quick in February. That's because it's crucial for investors to be able to confidently assess the businesses they hold. Intelligent investing is not complex, though. That's far from saying that it's easy, Buffett wrote in his 1996 annual shareholders letter. What an investor needs is the ability to correctly evaluate selected businesses. Note that word selected. You don't have to be an expert on every company or even many. You only have to be able to evaluate companies within your circle of competence. The size of that circle is not very important. Knowing its boundaries, however, is vital. It's important to remember that investing in the stock market always carries risk, and for many people, investing in individual companies isn't the smartest choice. You should talk to a trusted financial advisor before making any major decisions. For many investors, Buffett recommends low-risk index funds, which he calls the thing that makes the most sense practically all the time for retirement savings. He favors index funds in part because they take guesswork out of investing. The trick is not to pick the right company. The trick is to essentially buy all the big companies through the S&P 500 and do it consistently. In fact, after he's gone, he has said that he's instructed the trustee in charge of his estate to invest 90% of his money into the S&P 500 for his wife. Warren Buffett is a prolific investor. If you want to follow in his footsteps about the basics in trading and investing, follow these methods. If you like this video, press the like button and share this video with your fellow investors. Don't forget to subscribe to our channel for more awesome content.